Well, hello there, everyone. Welcome to another edition of Tip Tuesday. A little weird this morning, huh? Coming to you at a different time. We're trying to switch things around a little bit, see if we can find a time that allows us to be able to find more people that are able to attend live. Of course, you're able to catch the recordings on our various media outlets, but we want to try to move this around some a little bit and figure out what might work best for you guys from a live perspective. So appreciate you if you're able to join us live. For those of you that are going to be catching us at our normal time at 3:30 Central, this will be recorded by then. So hope you enjoy the recording nonetheless. So today's topic is about credit spread. So last week we introduced you to the concept of a debit spread. Today we're going to talk a little bit about a credit spread. Now, just as a reminder, our goal here is not to teach you how they work, what they do, all the ins and outs of a credit spread. It's just to give you a broad perspective of what a credit spread is, kind of in anticipation, a little build up of our boot camp 2.0 that's coming up here in a few weeks. So what is a credit spread? Well, the fact that it is a spread means it involves two option positions. Now, with this particular strategy, you're going to have either two calls or two puts. So you'll be buying one, selling another. The fact that it's a credit implies that money is received. So, as we talked about last week, when you're doing anything that results in a debit, money comes out of your account. So, this is kind of a really weird thing in that money actually comes into your account as you enter that trade, which is kind of a weird deal. It's not something we often think about. Like, how do I get money in my account without spending money? It's kind of a weird way of thinking about this. Well, um, you don't make money on anything regardless of what it is. Again, it could be a house, a car, a phone, cup, dirt, doesn't really matter. If you're going to make a profit on it, you have to sell for a higher price than you bought. But the key here is sell. So we have some stuff. If we are finished using it or we're tired of it, and we might have a garage sale, our plan is still to receive money for the things that we are no longer using or are trying to replace. If we were to just simply give that away, no money would come into our account. That would not be a sell, it would be a giveaway. So the moment that I sell anything, I ought to be receiving money or profit from the sale. And that's what happens in a credit spread. In fact, even though there are two legs involved, it could be two calls, it could be two puts. Um, what's a little different about the credit spread too is what we're doing is we're selling. So our primary objective is selling. So we're focused on what we call our short leg. So anytime that you sell to open, then that's a short position. And basically, then you would need to figure out, okay, do I want to cover that? And essentially, by having that other leg, it's your insurance leg with a credit spread. And then that keeps you from maybe having the exposure to such a big expense as if you were just selling to open, which would be called being naked. All right. So you'd be uncovered in that position. But the spread actually brings in an insurance leg and then covers up that position. And it does cap your potential expense there if the trade goes just really the opposite direction. In fact, one of the unique elements of a credit spread is that if you're able to reverse the short leg soon enough, you could actually make quite a bit more money on the trade because it actually went the exact opposite way of what you originally intended. So um, there's two types: the bull put. The first word is going to tell you what you want the stock to do. So you kind of do the biggest probably element here, the things that people struggle with when we teach this at our live events, is just understanding the concept of selling to open. So we try to break it down. So in our 2-day event, we're going to go over this in great detail. But the concept of selling to open is a little foreign, a little unusual for us to just think about, how am I selling something I don't even own? Why am I able to do that? Well, remember, market maker's job is to create a market so that you can buy and sell. Now, most of us think that that's chronological, that I buy then sell, and most of the time we do. But with a credit spread, our first action is actually selling, and then we come in and buy, which is, like I said, it's a little weird, a little different. And then you also have the added element of trying to think through, wait a second, what does that mean? Because now you're just coming off of maybe step 2. So you're like, I know what a call is, I know what a put is. And so if I buy it, then this call gains value because the stock does this. If I buy a put, the put gains value because the stock does this. So we're just kind of getting familiar with those things. We're getting a sense of how they work. And then you come into step 3, and it's like, all right, guys, now that you got a good sense of how calls and puts work, now we're going to throw a wrench in this whole thing and sell to open. So now you're just like, wait a second, it's a put. Did I want it to go up or down? It's like, what is it? Are you talking about the stock, or are you talking about the option? So I'm going to make this real simple for you guys today. Just always remember, it doesn't matter what you are selling, ever. Okay. Doesn't matter what you're selling. Dog, house, car, phone, cup, dirt. Doesn't matter. Okay. What you're selling. If you are going to make a profit, you have to sell at a higher price than where you buy. So that's never going to change. Now, we often think buy low, sell high, but we can easily flip that around, sell high, and then buy back low. And that's really the key element to a credit spread, is that you're actually going to sell. Your primary leg is selling. So you think to yourself, well, then how am I going to make money on this, since I've already put a cap on how much I can make? Because as soon as you sell, imagine that it's your house and you sell your house for X amount of dollars. Okay, let's just say, $500,000. You sell your house for $500,000. Can you make more than $500,000 on that house if you've been the sole owner and never rented it out? No, there's not, that's not a possibility. Why? Because when you sold for $500,000, you set a cap or limit on how much you can make, $500,000. Now you would go in there and say, well, once I subtract, how much I paid for the house, what my expenses were and all that, how much was my actual profit? But the selling, okay, puts an immediate cap on what we can make. So when we enter into a credit spread, it is a capped position because we are selling. So anytime you are in a position, a multi-leg trade, or even just a singular leg trade where you are selling, then you would put a cap on what you can make. Now the cap may be, pretty wide, but you have put a cap on what you can make. The other unique element to the credit spread is that it does allow you to make money if the stock kind of goes sideways, which normally what we would consider to be a directional trade. I'm either going to be bullish, stock is going to go up, and I'm going to be in a position where I benefit from the stock going up. Bearish, I'm going to be in a trade where I benefit from the stock going down. Now, we do have bullish credit spreads. We do have bearish credit spreads. So we can be directional in our general understanding of where we think the stock is going to go in that particular time period that we've allotted until expiration. But what's unique about a credit spread is that even if the stock goes relatively sideways, we have the potential to still make money. And what's kind of crazy about that is with a credit spread, you could make the same amount of money if you were in a bullish trade, if the stock moved up a penny or even down, let's say even a couple of dollars, or it moved up $100. You would essentially be making the same amount of money. So you could make money if the stock moved up a lot. You could make the same amount of money if it kind of went sideways. But you could even make money if it even went down a little bit. Now that's a very unique feature, particularly of a credit spread or something like that, where you're able to take advantage of this kind of neutral movement. So the nature and setup of the credit spread allows you to basically make money if it goes your desired direction. Cool. I mean, that makes sense, right? I mean, should. All right. Uh, but the difference here is we can make the same amount of money, even if it kind of goes relatively flat. And then we can also make money, even if it moves the opposite way of what we thought, but within reason. Okay. That's the kicker, right? That's the key. So it can move against me, but only so much before I'm going to see not only an expense, but it could be a sizable expense. From a risk return perspective, what do credit spreads look like? Well, depending on the setup, you could anticipate anywhere from a really small return on investment to sometimes 30%, 40% based on the way that we teach it at our events. 20% is probably pretty standard that we'd look for. Somewhere between 10 and 20% would be the expected return on investment for a normal credit spread. So if you think about it, you say, okay, what happens if I do get 10 trades where I make about 10%? I have a set amount of money and I set that aside. And I decide, somewhere over the next 12 months, I'm going to do 10 credit spreads where I make about 10% and I use the same amount every time. Where I think most people lose sight of this because they look at the risk return. And really, when you look at the risk return for a credit spread, it's not like a debit spread for sure. We certainly don't want to lose big on a credit spread. And that does happen to people. Now, we've got some weapons that we teach at our events to kind of help you out with this. Certainly, we want you to be prepared for that in case that happens, because if a credit spread turns against you, it could end up being a bigger expense. Now, remember, it's a capped expense. From the moment you enter the trade, you know what your potential loss would be, even if it went just terribly wrong. So that's already kind of established. So you already have that in mind. But it can be a big number. So since the risk return is not great, we want to make sure that we're still losing little. We are, winning big. It's like, well, maybe redefining what winning big is. But again, 10%. Let's just say that's a good win, particularly on this play using this strategy. So 10 times I pick. You know what? I'm just gonna, out of all the stocks, thousands and thousands of stocks I could pick, all these different strategies. I'm going to do a credit spread. I'm only going to do 10 of them this year. 10 of them, but I'm going to get about 10% each time I do one of these trades. And I'm going to limit it to only the ones I think that are absolutely the best. If I took those 10 trades and every one of them worked the way that I planned, then basically with trading just 10 times through the entire year, I could take a set amount of money, and with a 10% return on investment, I have the potential to then double that amount of money. Now, it assumes, right, okay, that I go 10 for 10. But again, I'm taking all year to limit myself with my education, my knowledge, to only the best trade setups out there for a credit spread. And that's the potential I have. So even though the risk return is not nearly as great as it would be, obviously in the debit spread, or even in a potential straight call or put, the upside is that if I can limit myself to the number of trades that I'm willing to use for a credit spread, and to really enter trades where I have a high probability of this working, where I have a decent return on investment, then over time, I may not even have to do that much trading to have a reasonable return, even maybe a nice return on investment for the year. So, guys, I would encourage you to check out more information. Visit tradeway.com if you want to learn more about credit spreads, about how we set them up, because there are a lot of options when it comes to the strikes that you choose, the pros and cons of those. There are some things that we want you to do to make sure if the trade goes the opposite way, that you understand what your options are. We basically have 4 different things that you could do. Some of those are certainly timing based. So timing is kind of important if you have to reverse out of a credit spread. So we want to teach you more about those things. We want you to take advantage of those. But the credit spread is a great strategy when employed the right way. And we would encourage you to take advantage of it. And if you want to learn more about these things, we sure would be glad to teach you. Thanks again for joining us for Tip Tuesday. We will see you next time.